when inflation, oil, and long bond yields all push higher while equities sit near record levels. The cross-asset balance can shift very quickly. Welcome to vTalkInsight, Allocator's Lens Daily for May 14th, 2026. Let us look at how equities, rates, credit, currencies, and commodities are lining up today. In equities, the central tension is an AI-fueled rally, driving major indices to fresh highs just as inflation and yields reprice the discount rate backdrop. The S&P 500 Nasdaq have been closing at or near records, with chips and AI names doing most of the heavy lifting, while volatility indices sit in the high teens, signaling only modest stress despite persistent macro noise. Under the surface, leadership remains extremely narrow. The top 10 stocks now account for roughly 40% of the S&P 500, and gains are concentrated in semiconductors and a small cohort of AI leaders, leaving financials, bond proxies, and more cyclical sectors struggling whenever yields push higher. For now, earnings are validating a lot of this strength. The median S&P 500 company has delivered a double-digit earnings surprise with an unusually high beat rate, and earnings growth is broadening to around 5 to 6% for the typical name, even as AI-heavy sectors report exceptional margins and multi-year capital expenditure plans. S&P 500 net income has climbed to about 9% of United States gross domestic product, well above past peaks near 6%, yet cash flow growth has been much more subdued over the last 2 years. Hyperscalers are driving reported profits with aggressive AI-related capex that now runs into the trillions of dollars annually, while their aggregate net cash has fallen by around $100 billion, increasing reliance on debt markets to fund this build-out. Against that backdrop, parts of the equity market are trading at valuations that invite comparison with past bubbles. AI-focused indices on the technology side are marked on 35 to almost 40 times forward earnings. Call option activity in tech and AI has surged, and skew and index volatility has tripled, as FOMO-driven flows chase stocks like Micron that have doubled in a month and newly listed AI names that carry large order backlogs but still modest near-term revenues. This has produced a two-speed market, where a narrow AI and semiconductor complex enjoys abundant capital and rising estimates, while many other sectors grapple with higher input costs, tariffs, and wage pressure. At the same time, cross-asset correlations have dropped to unusually low levels, which sounds benign, but also means there is room for a sudden spike in correlations and volatility if an exogenous shock forces investors to de-risk across the board. Rising long-term yields are a key swing factor in that shock scenario, with some desks flagging the 10-year United States yield around 4.5% as a psychological threshold for equity risk appetite. Near term, focus is on upcoming earnings from flagship AI names, where options imply large single-day moves, and on the Trump-Xi summit, which could deliver positive headlines around trade purchases even as export controls on advanced chips and the conflict in the Middle East remain unresolved overhangs. For allocators, the equity tape still looks strong, but it is increasingly dependent on continued AI earnings delivery, cheap financing for large-cap tech, and the assumption that higher long-end yields remain manageable. That makes the rates backdrop the natural place to turn next. The rate story is dominated by a renewed inflation scare that is pushing global yields higher and steepening parts of the curve. Recent producer price data in the United States surprised sharply to the upside, with headline PPI jumping more than 1% month-on-month and around 6% year-on-year, while consumer inflation has printed as high as 9% in some measures and roughly 6% on headline, with core above 5%, far from the Federal Reserve's 2% target. Those numbers have dragged Treasury yields back towards cycle highs, with the 2-year note above 4%, the 10-year approaching 4.5%, and the 30-year bond now above 5% at auction, the highest since before the global financial crisis. Similar dynamics are playing out elsewhere. United Kingdom gilts have sold off hard, with 10-year yields north of 5% and the 30-year nearing 6% amid political turmoil and fiscal worries, while long-dated Japanese yield have reached levels not seen since the late 1990s. Policy expectations have shifted with this move. The market has largely removed any near-term easing bias, with 2-year yields now trading above the current policy rate, and there is growing debate over whether further hikes could return to the table if demand stays resilient and energy keeps headline inflation elevated. even as some forecasters still project disinflation later this year and eventual rate cuts only out in 2027. At the same time, the absolute level of yields is starting to look compelling on a standalone income basis. Bonds in many markets now offer 5 to 6%. Investment-grade yields are 4 to 5 times higher than 5 years ago, and the 2 to 5 year sector of the curve is highlighted as a zone where investors are being paid for inflation uncertainty without taking the full risk of further long-end repricing, especially while institutional appetite for very long duration remains limited. One consequence is that sovereign bonds may offer better carry but less diversification than in past cycles, because upside inflation surprises now push both yields and risk assets in the same direction. With long-end yields globally rising and term premia rebuilding, the fixed income market is both an opportunity set in its own right and a potential constraint on how far the equity and credit rallies can stretch. Credit has so far absorbed the rates repricing with remarkable resilience. Corporate bond markets continue to see strong demand. Spreads in both investment grade and high yield remain close to historically tight levels despite heavy issuance, and yields in the mid-single digits allow investors to access higher quality paper without moving far down the risk spectrum. Alongside that, private credit remains a major growth area, offering a yield premium of roughly 1 to 300 basis points over comparable public credit and attracting increasing allocation from institutions in markets like Australia and Japan. The catch is liquidity. Core middle market loans are not naturally tradable, and structures that promise frequent redemptions against illiquid assets introduce the risk of stress if cash flows or sentiment turn, a concern already surfacing in some non-traded vehicles. Within corporate borrowers, the AI capex boom is also a credit story. Large technology and platform companies are issuing debt to fund massive infrastructure programs, and their net cash positions have already fallen by about $100 billion over 2 years, raising the possibility that bond investors will demand more financial discipline if leverage keeps edging up, which could eventually widen spreads for the heaviest spenders even if overall corporate default risk remains contained. Meanwhile, hedge funds are seeing their strongest net inflows since before the financial crisis, helped by back-to-back years of double-digit returns and an environment of higher volatility and dispersion across equities, commodities, and rates. That combination of tight spreads, richer yields, and cross-asset dispersion makes selection within credit and opportunistic trading strategies more important than broad beta exposure. In foreign exchange, the strains of higher inflation and energy costs are most visible in countries with external and fiscal imbalances. The United Kingdom stands out, with persistent current account and budget deficits, sluggish growth, and elevated inflation undermining confidence in sterling even as gilt yields soar and the country relies heavily on foreign capital to fund its borrowing. For now, the pound is supported by the need for the Bank of England to keep interest rates higher than in the euro area to attract that capital and contain domestic prices. However, commentary stresses that this strategy is unlikely to be sustainable without a more credible growth and fiscal framework, leaving a longer-term risk that sterling has to adjust lower in nominal terms if real competitiveness is not restored. India offers a related but distinct case, where the Middle East energy shock is pressuring the balance of payments. Foreign exchange reserves have been trending down. The rupee has touched repeated record lows, and the government is asking citizens to conserve fuel and reduce gold purchases and foreign travel, signaling both the political sensitivity of raising domestic fuel prices and the vulnerability of the currency to further oil price spikes. Against this backdrop, the dollar remains underpinned by higher yields and energy dynamics, while several Asian currencies are caught between the benefits of AI manufacturing demand and the risks around semiconductor export controls. The upcoming United States-China summit is expected to extend the current trade truce and may deliver purchase commitments in areas like aerospace. But meaningful relief on advanced chip export restrictions looks unlikely, keeping a degree of structural tension in the region's FX complex even if near-term headlines are benign. Commodities remain at the heart of both the inflation story and geopolitical risk, with oil once again center stage. Conflict involving Iran has sharply disrupted flows through the Strait of Hormuz. Satellite imagery shows tanker traffic from key terminals like Kharg Island at a standstill for days, and storage tanks are filling up on shore. all contributing to record-paced draws in global inventories and warnings of severe undersupply from agencies, such as the IEA. These supply stresses are filtering through the logistics chain. Major shippers like Hapag-Lloyd are absorbing hundreds of millions of dollars per month in extra fuel costs due to rerouting. Freight rates have risen and are expected to climb further into the peak season. And even if key sea lanes reopen, industry participants suggest it could take 2 to 3 months for shipping capacity and schedules to normalize. Interestingly, crude prices have so far shown some restraint, helped by earlier strategic reserve releases and initially high inventories. But that has delayed demand destruction and may be setting the stage for a sharper move if those buffers are exhausted. In the meantime, higher energy is already feeding through to inflation, with United States consumer prices reaccelerating and headline and core readings still far above target, reinforcing stagflation concerns and driving interest in broader inflation hedging that includes commodities, inflation-linked bonds, cash, and more resilient equity exposures rather than relying solely on nominal treasuries. Beyond oil, metals are also reflecting tightness and strong demand, with copper, iron ore, and silver helping basic resources stocks in Europe to outperform and push some miners to record intraday highs. At the same time, warnings that aluminium inventories could become critically low by year-end because of conflict-related disruptions and energy constraints underline the risk of further cost pressures for aluminium-intensive industries and add another layer to the inflation backdrop that policymakers and allocators need to monitor. Stepping back, the cross-asset picture today is one of powerful AI-driven earnings supporting equities at lofty levels, even as higher inflation, rising long-term yields, and energy shocks steadily pull the other way. Rates now offer some of the most attractive sovereign and investment-grade yields in decades, but may no longer provide the clean diversification they once did. While credit spreads remain tight, private credit grows, and hedge funds lean into the increased dispersion. In currencies, deficit and energy importers such as the United Kingdom and India are feeling the strain, and in commodities, oil and key metals sit at the center of both inflation risk and potential hedging value, with geopolitical events acting as major swing factors. Over the coming days, allocators are likely to focus on long-end yield moves, AI earnings and capex guidance, development from the United States, China summit, and any fresh signals on Middle East supply routes, as these will shape how the current balance between growth, inflation, and risk appetite resolves. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.